Wow, this is a really good question. What's the exit strategy for the investors, you ask me, in the event of a sale or initial public offering? See, the exit strategy for an investor in the event of sale or initial public IPO, we call it, is typically depends on the investor's investment goals and also the terms of the investment. Here are some of the common exit strategies that we see in the marketplace. One is, of course, selling the shares in the market. If the company goes public, IPO, then the investors can sell their shares on the open market, which my very good friend who I'll be meeting today, he's taken one company to NASDAQ. Now we are taking second company to NASDAQ. Hopefully my other partner will take two more companies to NASDAQ and, ring the bell and so on. So I'm very excited about it. The investors can choose to sell, or all of their portion of their shares if the IPO comes on and all that, depending on their investment goals. The other one is passive investors in the real estate typically invest in a syndication, like what I'm really into it, and managed by a sponsor or general partner like Vinny Chopra. By the way, I'm not selling any security, but as a result, as such, the exit strategy for the investor will be depending on the specific terms of the investment, and then outlined in the fund syndication operating agreement and everything. In the event initial, like if you get a refinance, for example, a big money where the equity now is taken out in the cash, we could return the investment back. That could be one place to exit right there. Secondly, when we sell the properties, we increase the NOIs, net operating incomes, with the cap rate and all. So the valuation increases, and many of the syndicators in real estate, commercial and all these, they're able to exit strategy. They tell the investors ahead of time, and then in 3 to 5 years, they'll exit and then investors, if it's stipulated, they could do 1031 of their gains into another asset and so on. Or if it's through their retirement plans, that's tax deferred anyway. So it's with the cash when you invest into a deal, that's when you pay taxes. The big tax bill comes in recapturing of the cost segregation dollars. We have had this big surplus of bonus depreciation and all, and a lot of negative K1s are going out, as you know, to investors, but they have to be recaptured at the exit level. When you sell the property, we have to recapture the sales price from the bottom purchase price minus the depreciation all the way down. So that whole gain, then we have to pay the taxes, the limited partners and the general partners. So accredited investors, in commercial real estate investments typically have access to a wider range of investment options, to get them. Just like I was mentioning, it's the strategy of refinancing, or to be able to even put it into REIT and other stuff, like that. But in many commercial real estate investments, the exit strategy is on the sale of the underlying property. That's when. So please look into all these things. And, again, in some cases, IPO may be an alternative exit strategy for the commercial real estate investments. This is less common, but can occur, when a property is owned by a real estate investment trust, REITs, we call it, right? REITs. Or when a real estate company decides to go public, which I said IPO in this my broadcast. So, in the scenario, the shares of the REITs or the real estate company would be, involved in returning your money back. Thank you.